Welcome to Tech Monetize Official. Today we're diving into the real estate market. Are we in a bubble or is this the new normal? Real estate decisions can make or break your financial future. I've built my career in New York City real estate, seen booms and busts, and know how quickly things can change. The current market feels familiar, but it's not a repeat of the past. We'll break down what's driving prices, what a bubble really is, and how you can protect yourself. No jargon, just real talk from someone who's been in the trenches. We'll cover why prices have soared, what experts are saying, and my tips for buyers and investors. My goal? Give you the confidence to navigate whatever comes next. If you find this helpful, hit subscribe for more insights on business and finance. Let's get started and make sense of this wild real estate market together. Stick with me. I'll keep it simple and actionable. Ready to become a smarter player in the game? Let's jump in. What's a real estate bubble? Picture blowing a gum bubble. It gets bigger, looks great, but eventually pops. In real estate, a bubble forms when prices rise much faster than their true value, fueled by hype and speculation. People buy, expecting prices to keep climbing, not realizing the foundation is shaky. The problem? These prices aren't supported by incomes or rents. They're driven by emotion and fear of missing out. When reality hits, like higher interest rates or job losses, confidence vanishes. Buyers disappear, sellers drop prices, and the market corrects, sometimes sharply. That's the pop. Values fall, and some end up owing more than their home is worth. The key is spotting when growth is healthy versus when it's just hype. A strong market grows steadily. A bubble grows too fast and lacks roots. I've learned to spot the difference, and it's not always obvious. Today, we need to ask, is the current market a strong tree or a weak weed? Understanding this helps you avoid costly mistakes. Let's look at what's really driving today's prices. Stay sharp. Recognizing a bubble is half the battle. Let's dig deeper. House prices have skyrocketed since 2020, one of the fastest jumps in history. In some areas, homes shot up 20 to 30% in just a couple of years. This isn't normal growth. It's a massive shift. Bidding wars, waived inspections, and buyers stretching budgets became the norm. Even as the pace slows in 2025, prices remain near all-time highs. Homeownership is now less affordable than it's been in decades. When regular families can't buy regular homes, something's off. This historic surge is fueling the bubble debate. Are these prices sustainable, or are we due for a correction? Understanding the scale of this run-up is crucial before we look at why it happened. Let's break down the causes. Why did prices explode? It's a perfect storm. Ultra-low interest rates made borrowing cheap, letting buyers pay more. The pandemic shifted demand. People wanted bigger homes, more space, and left cities for suburbs. Millennials hit peak home buying years, adding to the surge. Meanwhile, supply lagged. Years of underbuilding, plus pandemic supply chain and labor issues, meant too few homes for too many buyers. High demand, low supply. Basic economics says prices go up. Add in FOMO buyers rushed in, fearing they'd be priced out forever. This led to emotional, rushed decisions and even higher prices. The result? Explosive, unsustainable growth. It wasn't just one factor, it was everything at once. That's why the market feels so extreme. Let's see if it's really a bubble or something else. Here's what the experts say. So, are we in a bubble? Many experts say yes. Their case prices are way above what most people can afford, classic bubble territory. Price-to-income ratios are at record highs, and risky buyer behavior, bidding wars, waived inspections, looks like past manias. The end of cheap mortgages means fewer buyers can afford these prices. History shows rapid growth is often followed by sharp corrections. The 2008 crash had similar warning signs: fast price hikes, risky loans, and a belief that this time is different. Those who see a bubble believe we're at the peak of a cycle, and a correction is inevitable. The only thing holding up prices was cheap debt. Now that's gone, gravity could take over. It's a convincing argument, grounded in history and fundamentals. But is it the whole story? Let's hear the other side. Not everyone agrees we're headed for a crash. Here's why some experts say it's different this time. Not everyone thinks we're in a bubble. Today's fundamentals are different from 2008. No reckless lending or subprime loans. Lending standards are strict. Most buyers have solid credit and real down payments. The supply shortage is real, not artificial. Years of underbuilding mean too few homes in the right places. Even if demand cools, low supply keeps prices from crashing. Demographics matter. Millennials are buying homes for families, not flipping for profit. This is genuine long-term demand, not just speculation. Many homeowners refinanced at low rates and have lots of equity. They're not likely to panic sell. Most can afford their payments and will wait out any downturn. This stability makes a 2008-style collapse less likely. Prices might flatten or dip, but a crash? Unlikely with these fundamentals. The market's base is stronger than it looks. Still, risks remain, so stay informed. If you appreciate this balanced view, subscribe for more. Now let's look at what could happen next. What's next? No one can predict the future, but here are 3 likely scenarios. First, the Great Stagnation. Prices stay flat or dip slightly as high rates and low supply create a standoff between buyers and sellers. Second, the Soft Landing. Inflation eases, rates drop, and wages rise. Prices stabilize, then grow slowly at a healthy pace. Third, the Hard Correction. A recession triggers job losses and forced sales, causing sharp price drops in overheated markets. The most likely? A mix. Some areas stagnate, others correct, a few rebound. Watch 3 things: interest rates, unemployment, and new home construction. High rates and job losses mean trouble. Lower rates and strong jobs mean stability. The outcome will vary by location. Stay alert to local trends, not just national headlines. The market's path depends on the broader economy. Prepare for anything. Don't bet on just one scenario. Let's talk about how to make smart moves no matter what happens. Here's my advice for buyers and investors. What should you do now? If you're buying a home to live in, don't try to time the market. Focus on your needs and buy when you can comfortably afford it. Plan to stay at least 5 to 7 years. Real estate is a long game. Keep your total housing costs under 25% of your take-home pay. Don't stretch your budget or rely on future price gains. For investors, be extra cautious. The days of easy profits are over. Make sure the numbers work from day one. Rental income should cover all expenses and leave positive cash flow. Don't buy hoping for appreciation, buy for income now. Every market is local. Study your area, talk to agents, and know the trends. Look at inventory, days on market, and local job growth. The more you know, the better your decisions. Knowledge is your best defense in any market. Stay disciplined, and you'll thrive, no matter what the headlines say. Let's wrap up with my final take. So, are we in a bubble? Not like 2008. Lending is safer, supply is tighter, and homeowners are stronger financially. But prices did overshoot. Expect a slow deflation or years of stagnation, not a dramatic crash. Overvalued markets may drop 10 to 15%. Others will stay flat as wages catch up. Sellers may struggle to get peak prices, but patient buyers will find opportunities. Ignore the noise. Focus on your finances and long-term goals. Don't let fear or greed drive your decisions. Buy in good locations at prices you can afford and plan to hold for the long run. These rules work in any market. Build wealth by staying smart and disciplined. Thanks for joining me at Tech Monetize Official. If you want more clear, actionable advice, subscribe now. Invest in your financial education. It's the best move you can make. Stay smart, and I'll see you next time.